Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 17th of January and we have as our guest today, Jeffrey Halley, Independent Market Analyst. Jeff, thanks for coming in.
Always a pleasure.
Now, Jeff, for a start, let's take a look. Before we get your insights, I want to take a look and see how regional markets have performed. In the first half of the day, we start with Malaysia. The KLCI is down 0.3%. Shanghai is down 0.7%. The ASX All Ordinaries is down 0.42%. The Nikkei is bucks the trend. It's up marginally 0.25%. But then we've got a bit of a bloodbath in the Hang Seng and the Kospi. The Hang Seng is down 2.93%, and the Kospi is down 2.02%. Jeff, your views on market performance in the first half of the day?
Well, it's really two words. Well, let's make it three. Poor China data. So we saw China's GDP come in year on year at 5.2%. Markets were pricing in 5.3%. With data from China these days, and given that they didn't cut their one-year MLF earlier this week, it doesn't take much for traders to want to hit the sell buttons with regards to Chinese equities at the moment. So we also saw China retail sales fall and unemployment rise, and that's just adding to that whole feeling that China is in this extended slowdown with no sign of it ending, and B, that government's apparent inaction on putting a floor under this slowdown is nowhere to be seen as well. And those two factors are contributing to this selling. That's had the impact, of course, what we've seen in Hong Kong, but also dragging down equities across the region. The only reason I think the Nikkei's rallied today is because the US dollar rallied overnight and we've seen a weaker yen. When we look at Asian markets, though, they were probably going to be negative today anyway, because New York had a slow day overnight as well, led by Apple after they announced discounts on iPhones in China. Some mixed bank earnings as well. Goldman's did well. Morgan Stanley didn't do so well. But really, one of the Federal Reserve governors, Federal Reserve Speaker Waller, came out and said that inflation would need to be lower for an extended period of time before the Fed would consider rate cuts. And that hawkish noise was enough to see the US dollar rise. Precious metals got absolutely crushed, and we saw equities come lower. And that all reflects on this very crowded Fed easing trade that we're seeing in the markets right now.
Now, on a different note, and closer to home then, we've got Bank of Indonesia rate decision shortly today. Are we expecting any surprises?
I'm not expecting any surprises, which means it probably will be a surprise. But I'm expecting Bank of Indonesia to leave rates unchanged at 6%. I mean, we can see the reaction in the markets to hawkish statements from Federal Reserve governors overnight. We saw the US dollar rally substantially with that blowback through other commodity classes. I think there's no reason, given Indonesia's strong fundamentals at the moment, for the Bank of Indonesia to be in a hurry to ease rates. They'll also have one eye on the rupiah as well, the Indonesian rupiah. They don't really want to be cutting rates aggressively before the Federal Reserve starts doing so. And I think that's also going to be reflected in other developing or EM markets around Asia over the coming months.
And really, this also Jeff, stems from the key point that there's quite a spread between US rates and emerging market Asia rates. So, there's, for example, for Malaysia, there's almost a 2% spread.
I think Malaysia is probably the best of the bunch, though, because Malaysia's economy has diverged from, say, Singapore to a certain extent, but most certainly from Indonesia post-COVID. It really has been the laggard in the region, and that is reflected in the fact that they really haven't had to aggressively hike rates, or they have shown no inclination to do so.
Now, Jeff, we're in the middle of the week. What else are we looking at for the rest of the week from a data point perspective or event perspective? that could move markets?
I think we've got quite a lot of potential for some pretty aggressive whipsaw price action. And I'm talking across the currency markets, the bond markets, precious metals, and of course, equities. And the reason I'm saying that is because of the reaction that we saw to Waller's speech from the Fed last night. There's a lot of Fed speakers this week. My count over the next 24 hours is 4. There may be more, and there's definitely more coming out on Friday. And depending on which side of the easing, not easing fence their comments come down on, we know that the markets are going to react to that. So it's one of these markets where you have to be pretty nimble, I believe, because that's really what's driving the short-term price action. And that's because this Fed easing trade is so crowded globally, and that's why we get these reactions. Elsewhere, we've also got the head of the ECB speaking, and we've also got US retail sales. Now, if those were to come in weaker tonight, that potentially could reinvigorate the Fed easing trade, but on the other side of things, they could come in stronger and everybody will run for the door again. It's that sort of market. We can't really discount anything coming out of the Middle East either. Let's be honest. There were more airstrikes in Yemen overnight as well. So we can't discount any geopolitical surprises. So I guess most surprisingly, amongst all of this noise, it's actually been Bitcoin that's been the most steadiest and boring of the asset classes, if you like, that we've seen this week, and I can't explain that.
Now, on that note, Jeff, I've never heard Bitcoin described as boring. Now, thank you very much for your insights. Thanks for coming on the show.
A pleasure.
Now, we've been speaking to Jeffrey Halley, an independent market analyst. And this has been BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out our show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.